3 common investing mistakes. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein or cup of coffee. Let's have a look at this article from ABC Everyday. So, starting out investing, here are 3 common mistakes to avoid. I thought this would be interesting to have a look and see at the common mistakes they're suggesting, because a lot of people have started out with investing. Remember last year we were looking at articles about people jumping in and proudly investing in holidays and tourist accommodation. I wonder how those investments have gone now. Hopefully good. If it was Flight Centre, they seem to be picking up if you got in the dip. But if you didn't, well. So, when you first start investing, it can seem like a very steep learning curve. You might spot an investment opportunity that looks attractive, only to find out later it's a dud. You can get the timing wrong and lose money, or find yourself investing in something you don't really understand. The truth is, mistakes are inevitable in investing, especially when you're starting out. Even the best investors stuff up from time to time. Some mistakes, though, are easy to avoid, and understanding where others have gone wrong can save you money over the long term. With that in mind, we spoke to 2 young investors about the beginner mistakes, what they do differently, and if they'd had their time again. So number 1, not having a clear investment strategy. Yeah, I can relate to that, particularly when I was getting into crypto or when I was playing with CFDs. Yeah, that sometimes it can be more like gambling than investing. So Melissa Ma, 25, is co-founder of a financial education social enterprise aimed at helping young women with their finances. Growing up, she was curious about investing. It was talked about in her family and she'd read about it. So when she was 18, she decided to try it herself. Her biggest mistake, she said, was that she didn't have a real strategy or plan. I had my money in about 2 or 3 different individual company stocks, and because of that, I wasn't very diversified. And I was actually exposing myself to a lot of risk, she said. Even if one of those 2 companies went south, I could end up losing a big chunk of my money. Kate Campbell is another young investor. She's studying business and finance and produces a podcast about personal finance and investing. I mean, this is good to see young people showing an interest in investing. This is one of the advantages we have these days for access to all of this information. You know, we don't learn about it at school. I don't think we're ever going to learn about it at school. There's already too much in the curriculum. As someone who homeschools, just looking at how much you have to fit in the curriculum, it's just nuts. It really is. So Kate, 23, started investing around the same age as Melissa, and she had a similar experience. I bought and sold the most random companies, and I had no understanding of the market or investing or compound interest, she said. I think if I continued down that path, I probably would have been scared of investing for life. I won some and I lost some. I was really just gambling. She was buying and selling all the time too, which caused headaches at tax time. When you file your tax return, you have to account for any profits or losses and income from your investments, such as selling shares or receiving dividends. For Kate, it was a nightmare. I didn't keep any records. I just had no idea about any of that. I tried different apps and platforms, and the tax department had some info, but you have to figure out the rest, she said. I think for new investors, just sticking maybe with one broker to start with and not jumping around different platforms is a good way to go. I would suggest keeping an Excel record of everything separate from the brokers. I've been doing that with my pocket money investing, so I track every dividend I get in, because that's the strategy I'm using now, is to build up a portfolio of just dividend-producing companies across a range of fields. I've been leaning towards real estate investment trusts, particularly in the US, and they've been a bit of a mixed bag. They've been surprisingly well, a lot of them, and I just track it. So I see every month my dividend payment is just going up, creeping up a little bit more and more. That's the goal. But you want to keep it in your own separate file, not dependent on them. So, mistake 2, expecting to get rich quick. Both Melissa and Kate like to invest in the stock market. Stocks have been a good long-term investment opportunity in Australia, returning about 10% over the last 100 years. But over the short term, the stock market can fluctuate widely, like we've seen since the onset of COVID-19. When it comes to these ups and downs of the market, we need to understand that the economy goes up and down, but in the long run, it usually has a trend of going upwards, she said. We've gone through a lot of turmoil. We've gone through the world wars, the Great Depression, the GFC, and most recently, we've gone through the pandemic. But after each one, whether it takes months or years, the economy will always recover. And while stocks, property, and other investment options have been on the rise lately. Melissa says it's important to remember that prices can fall too. I'm a little bit worried about those who start investing at the beginning of the pandemic, have a perception that the market does so well, and if they keep investing, they'll get 20% returns. There's a risk that with when the market falls down a bit, they freak out because they've never experienced a market dip before. Well, see, that's the one advantage of crypto. You can get an entire lifetime's worth of market conditions condensed into one day. In some ways, playing around in crypto, particularly if you're not putting too much money in and trying to trade, flip it and day trade it, is a really good way to just get used to, winning big and then losing it all in an instant. What do you think about that one, guys? So, mistake 3, not investing at all. One of my biggest regrets is that I didn't start investing earlier. It turns out to be a very costly mistake indeed. To explain why, consider the following. Let's assume one investor, Anastasia, starts investing $1,200 each year at the 20 and earns 10%. By 60, she would have more than $530,000. A second investor, Raven, also invests $1,200, earns 10%, and she starts 10 years later at 30. She'd end up with just under $200,000, less than half of Anastasia's amount. It's a reminder that time is often the most important factor in investment returns. And even if you're not feeling completely confident, it's important to start somewhere. Well, you could just chuck it all in an ETF then, couldn't you? I think if you're young and you're having a go, you have to be prepared that things aren't going to go right all the time, and you're going to make some mistakes. It's part of the journey. The key thing Melissa says is to treat those mistakes as learning opportunities rather than beating yourself up about them. I really wish I started investing younger and I made more mistakes so I could learn from them. Over time, you have to be able to develop a better portfolio earlier. So there we have it. 3 common investing mistakes: not having a clear strategy, expecting to get rich quick, and just not investing at all. What do you think, everyone? Let's have a bit of a talk about these. So honestly, I think there's some pretty solid generic advice there. And I'd encourage younger people particularly to get in and to be sensible. I like the dividend approach to investing as a strategy. For long term, just build up, get diversity and build up passive income. If you want to look at something else, you can probably look at some ETFs, some funds like that, or maybe go to a broker. But at the very least, get investing, get used to it, and don't be afraid. But like always, don't invest more than you can afford to lose. I've heard so many stories of people just throwing everything at some get-rich-quick scheme, at some crypto scheme, selling the house, losing it all. It's not worth it, guys. It's just money. Anyway, thanks for watching. Like, share, and subscribe to the channel. If you're a fan and enjoy the news and content I cobble together here, there are a few ways you can support us. You can join us on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time. Bye for now.